The Fed is lying, not to the markets, not to the media, to itself. While bond markets scream distress, gold holds the line and the dollar quietly erodes. The Federal Reserve continues to issue the same tired reassurance: the economy is strong, the labour market is solid, inflation is under control. It's not, and they know it. Behind the curtain, the debt is exploding. Interest payments are cannibalizing the federal budget, and global investors are beginning to step back. The price of default protection on US government debt has surged to crisis levels, and yet the Fed sits still, boxed in by the very system it helped to inflate. Today, we're going to show you why the Fed's own story is falling apart, what the markets are really signaling, and why the illusion of control may finally be coming to an end. According to the minutes of the May Federal Open Market Committee meeting, economic activity is expanding at a solid pace. The labour market is strong. And policy? No intervention needed. Never mind the sharp sell-off in long-dated treasuries. Ignore the yield curve steepening like a ski jump, and dismiss the fact that the US dollar has been quietly losing altitude against major currencies. Apparently, all is well in the House of Powell. Except, of course, it isn't. Let's start with the debt. As of today, the US national debt is north of $35.9 trillion. The Treasury is now adding $1 trillion of IOUs every 100 days, not every year, every 100 days. Interest on that mountain of debt is set to surpass $1.1 trillion this year, more than the US spends on defense or Medicare. And according to the Congressional Budget Office, the federal deficit will hit $2.5 trillion in 2025. But the Fed insists that economic fundamentals remain solid. It would be funny if it wasn't so deeply fraudulent. Now, Thomas DiLorenzo, who's president of the Mises Institute, calls the Federal Reserve legalized counterfeiting, and he's not wrong. If you or I printed money in the basement to fund our bad habits, well, we'd be behind bars. But when the Fed does it, it's called monetary policy. This is not some fringe view, it's just the simple truth. The US government spends far more than it earns, and the central bank enables it. The Fed monetizes debt and hides the real cost of Washington's expansionist addiction. And whether it's military interventions, surveillance boondoggles, or corporate bailouts, they fund it all with fabricated money. Did Congress send you a bill for $100 billion to Ukraine? No, but you paid for it anyway in higher food prices, housing costs, and the quiet theft of your purchasing power. They don't tax you for it, they inflate the currency. That's not fiscal policy, it's monetary fraud. So let's be clear, the Fed's current posture, with rates on hold and optimism about growth, is not the result of sound analysis. It's the product of institutional denial. They're clinging to a fantasy that everything is working because they desperately need it to be true. The minutes from the May FOMC meeting were a masterclass in delusion. On one page, they admit that longer-term treasury yields are rising, that equity markets are volatile, that liquidity in the treasury market deteriorated after the April 2nd tariff announcements. They even acknowledge that market participants are pricing in a recession. And then, astonishingly, they conclude that the economy is expanding at a solid pace and the labour market remains resilient. They are not managing a crisis, they're pretending it's not happening. But the bond market is not fooled. 10-year yields have punched through 4.5%, while 30-year yields are flirting with 5.1%. That's not just a warning light, that's the dashboard on fire. These aren't theoretical models or policy talking points. This is the cost of capital screaming that something is wrong. Trump's latest budget, the so-called One Big Beautiful Bill, is a $3.3 trillion exercise in economic hallucination. It exceeds the 2017 era tax cuts, it slashes healthcare for the poor, and adds more debt than the US incurred during the entire Second World War. And what's the Fed's response? Silence. Passivity, a shrug, followed by a soothing, "We're monitoring the situation." It's not just incompetence, it's complicity. And the Federal Reserve is the enabler in chief. Without it, the illusion of endless money and endless war would collapse. DiLorenzo puts it plainly. The Fed makes it possible to have endless wars, welfare expansion, unconstitutional surveillance. It's monetary socialism. This is not a partisan point. Every administration, Clinton, Bush, Obama, Trump, Biden, has added to the debt. Fiscal insanity is bipartisan. The Fed just provides the magic trick that lets it all continue. The Treasury borrows, the Fed buys. The dollar gets weaker, your savings erode. But hey, stocks are up. So what's not to like? For over a decade, the Fed waged war on savers. Near zero interest rates after 2008 destroyed the incentive to save. Retirees earn nothing on their deposits, so they chase yield, buying riskier assets, stretching into junk bonds, pouring more money into overpriced tech stocks. And now, with real inflation climbing and rates back up, the bill has come due. Savers are being punished again, this time not through zero returns, but through rising living costs and falling real wages. Inflation is a regressive tax. It hits the poor and middle class hardest. It's not just bad economics, it's immoral. Yet the Fed wants credit for cooling inflation, as though they didn't cause it in the first place. And this is the bit that should really worry you. The rest of the world is no longer convinced that the US is a safe bet. Global investors are now actively diversifying out of US debt. European, even Japanese and Australian bonds are gaining appeal, and even previously unloved borrowers like Italy and Spain are getting a second look. Why? Because America's behavior has become, in the words of Amundi's CIO, fiscally undisciplined. JP Morgan's Bob Michel says clients feel heavily overweight in dollar assets. PIMCO calls it prudent to seek high quality debt elsewhere. And Goldman Sachs, well, they warn of weakness in the dollar that has some permanence. This is not the beginning of a healthy correction. It's a loss of confidence, and confidence is the only thing keeping the fiat system together. The traditional role of treasuries is simple. Be the place you run to when everything else burns. But recently, treasuries fell even as stocks sold off and the dollar weakened. That's not supposed to happen. That's the canary choking in the coal mine. The FT even called it an emerging market-like response, falling bonds and falling currency all at once. That's not a flight to safety. That is a run for the exit. And it's not just investors, it's the Fed itself. In the same breath, they acknowledge rising volatility, this liquidity stress, and yield curve distortions. They insist that the system is resilient. You can practically hear the desperation. If yields breach 5% on the 10-year, you'll feel it everywhere. Mortgage rates, credit cards, auto loans, corporate debt, all repricing upwards. More government debt means more supply. More supply means higher yields. Higher yields means slower growth, weaker profits, more layoffs. It's not just theoretical, it's already unfolding. Credit default swaps, insurance against a US government default, have quietly surged to levels not seen since the 2008 financial crisis. It now costs over $51,000 a year to insure $10 million of treasuries. That's up from $29,000 just months ago. This isn't just market noise. This is a real-time signal that sophisticated investors are hedging against a US debt event. And meanwhile, Japan, one of America's largest creditors, is seeing its own bond market unravel. The yen carry trade is unwinding. Japanese long bonds are collapsing. Auctions are failing. JP Morgan warns the deleveraging is only halfway done. If Japan starts selling US treasuries to stabilize its own market, it's not a what if, it's a when. And when that happens, the era of easy money truly ends. So where does this leave us? Well, the Fed is boxed in. Can't raise rates. The debt is too large. It can't cut rates. Inflation would roar back. It can't admit the problem. That would tank markets. So it tells itself a story. The labor market is strong. Growth is solid. Inflation is contained. Meanwhile, New York Fed President John Williams says central banks must respond relatively strongly when inflation deviates from target. He warns that allowing inflation expectations to shift could make high inflation permanent. But that's exactly what's happening. Inflation remains elevated, the dollar is weakening, and the Fed has kept rates frozen since December, paralyzed by the political and financial cost of doing anything meaningful. This is not cautious policy. It's cowardice disguised as patience. They are not buying time. They are wasting it. We are at a point where foreign capital is pulling back, where domestic confidence is wobbling, where inflation remains persistent, and where gold, this ancient barometer of instability, is quietly staying strong and breaking out. The Fed is not managing an economy. It's babysitting a narrative. And narratives, like fiat currencies, only work if people believe in them. But they're starting not to. Not really. They're just waiting to see who blinks first. So rather than waiting for everyone else to blink, why don't you get yourself sorted? Download our guide, get your exit plan. The link's below.